All right. Well, hey, everybody. I'm sitting here with Tamar Mar, and Tamar is somebody who I met through Facebook not long ago because we both enrolled in the Pat Flynn Power Up podcasting course like
Yes.
6 or so months ago.
Uh-huh.
And she kind of noticed me because I was one of the few real estate people doing a podcast. And when she kind of told me her story and, just told me a little more information about what she was doing, I thought, hey, that would be a great interview. And she's already had me on her show as well. Tamara has a really cool story. I think it'll be interesting to those of you out there who maybe you're in a job and you sort of want to get out of a job, or if you're interested at all in commercial real estate or syndication or anything like that. She has a lot of interesting things to share. So, Tamar, welcome.
Thank you, Seth. I'm super happy to be here. Thanks for having me.
Absolutely. So, for those of us out there who have not heard of you or don't know your story, maybe in a few minutes or however many minutes it takes, let us know what's your story, what's your background, how did you get into real estate investing?
You mean not everybody knows who Tamar Mar is? I mean, I have a cool name.
Most of us do, but for the three of us that do not.
Totally kidding. I'm so not famous. I'll share a little bit about myself. So, I've been involved in real estate for years. I bought my first house when I was 19, believe it or not, which is so crazy because, that's really what normal 19-year-olds do when they're working full-time and putting themselves through university full-time. So I've had a flair for real estate for some time, but we've had rentals. My husband and I have been married for 17 years, and we've had rental properties for most of our married life. And part of it was just accidental because we had moved into a house here in the Seattle area. And about a month after we moved in, I found out my job was taking us across the country to Minnesota for me to be an outside sales rep. And so we said, well, shoot, we'll just turn this thing into a rental. We bought a house out there, and we used some of the proceeds to pay for both this mortgage and the other mortgage because it was in such a good market.
Nice.
And we moved back, and it was a number of years after that until we took our next step. But about 4 years ago, where the current story comes from is I had been the COO of a regulatory solutions company on Wall Street. And I loved it. The startup culture was amazing. I had been in startup culture for a really long time. I love growing businesses, but something stirred inside me to just say, I know if I can do this for somebody else, help them grow their business into a multi-million-dollar company, I can do it for myself. But the problem was I just didn't know what it was going to be that I wanted to have my own business with. It was like, I don't want to make artwork. I don't want to, I don't know. I'm not a scientist. I don't know. I just couldn't think of anything. And so my husband's family had been involved in real estate ever since he could remember, all up and down the West Coast. And we had been talking for years about buying apartments and such. But it seemed so big to us. Like, how would we even get into that, right? And so this idea of real estate clicked. And right around that time, I had read The Millionaire Real Estate Investor. And there were all these stories about people that had, portfolios of 100 rental properties, and they were living off passive income. And that was the first time I really heard about this passive income concept. And I thought, this is it. This is what I'm going to do. I'm going to build up an empire of real estate for us to live off of eventually. And since I'm a person of massive action, it didn't take long before we started buying houses on auction, sight unseen, working on them as a family together, turning them into rental properties. And we did that for about 3.5 years. And then about a little over a year ago, December of 2016, I had one of those moments. I was a COO for a different company, a local company. And the thought came back to me about wanting to have my own business because I had been doing all of this while working full time. So I just had this one day where I thought, you know what, this is it. I don't want to be anybody else's employee. I'm never going to be somebody else's employee again. I want to be the CEO of my own dreams, not somebody else's dreams. And I had no idea what I was going to do, but I decided to quit my job. And don't just quit your job if you're a new real estate investor or even a mildly seasoned one. Luckily, my husband had income too, but I just knew that if I quit and I focused on growing our portfolio, I could do it in a much more impactful way than if I was working full time. So I did that and started focusing on syndications of multifamily apartment buildings, and have been growing my business massively in the last year and a half. So that's like a big picture idea of who I am and what I've been working on lately.
It sounds like you're one of those people who is not afraid to take action, get uncomfortable, put yourself out there and make things happen. I know for a lot of people, they sort of lean one way or the other. Either they are an action-oriented person, and they sometimes even act like before they know what they're doing. And other people, well, I think more people actually that I know, will sort of just like spend all their time learning and just like analyzing things before they ever take action, if they ever take action. So I'm wondering, for somebody like yourself who has clearly taken action, like, did you feel like you had enough information when you started moving, or did you make any mistakes? Did you act too quickly with anything, or?
Yes to all of those things. So, well, I don't think I acted too quickly. Here's something about me. I always act before I think I'm ready.
Okay.
I always act before I think I'm ready. And the reason why is because one of my favorite things to do in this life is to try stuff I've never done before and figure out how to make it happen. That whole process of like, there's this big thing and I have no idea what I'm doing, but I'm really smart and resourceful and I'm going to figure it out. That whole figuring it out process sets me on fire. It just makes me feel really alive, and being uncomfortable. Like I remember I started writing a blog article a while ago about learning to be comfortable with being uncomfortable. That whole concept of like, it never feels good to be uncomfortable. But once you get through that process of, now look what I've achieved. And so it's almost like an addiction to that thing of, let me just try something new. Right. And no, I don't think I knew everything that I needed to know, but does anybody ever know everything they need to know before they start something new?
I don't think so.
No. And I had been researching and all real estate investing for, I don't know, before I started doing the syndication. I had been involved in it heavily for 4 years, and through, listening to Bigger Pockets and reading tons of books and blog articles and all this stuff. But there's always something new to learn. So no, I still feel like today I don't know nearly everything.
Yeah, that when you were talking, that kind of reminded me of the Ralph Waldo Emerson quote. He said, always do what you were afraid to do.
I love that. I love that so much. Last year was actually, I consider it to be probably the best year of my life. I think this year will top it, but it was this amazing year. And I think part of it was because this unleashing of working on what I knew I could, like chasing my dreams. Right. And we also bought a company last year as well. So I'm a business investor in addition to real estate investing.
Okay.
And, for some reason last year, I said, this is the year I'm going to start chasing my fears. And I just want to go after them with wild abandon. I always use the concept of like a bear as like this big fear thing, because I started backpacking last year again for the first time in 20 years. And, and I'm scared of bears, I mean, like, who isn't? I don't know. They're kind of freaky, but I just thought, you know what? I got to go. This one time I decided to choose a trail that the most bear activity was reported on, because I said, I have to go do that to prove to myself that I can go somewhere where I know there's these things, so that when I actually see it, it's not going to be as bad as I think it is. Right.
Yeah.
So I love chasing fears.
Yeah, bears are things that I lose sleep at night worrying about bears going to kill me. So I understand. So this whole decision to quit your job, what was the hardest part about making that decision? Like what was it that clicked in your mind that said, okay, it's never been okay until now. Like, now I'm ready. Was it like where you and your husband were at financially? Like, were you just sort of comfortable, or had you just like, did something happen and you just had enough? You were tired of working, or what happened there?
I think it was kind of a perfect storm of a number of things. Regarding the financially sound thing, that was the thing that I was the most scared about, because it's freaky giving up a really nice executive package.
Yeah, for sure.
If nothing else, I mean, we've always tried to live off of one income so that I can do what I need to do at different times with, we have 3 kids and stuff comes up and all this. And then my income has always been for play. for extracurricular activities, for investing, and for travel and such. And so we always kind of would make ourselves feel like we were tight so that we could invest a lot and do the things to set us up for our financial future. Yeah. But still giving that up, it's like a security blanket, and it's freaky. Sure. Right. And I think both of us were freaked out about that, but we also knew that it was confident that I would be able to make up for it in no time. Yeah. And so honestly, it came down to, I think, this conversation I had with somebody, an old friend that I had worked with, and we were in talks of me going back to her company to be the CEO on Wall Street. And we were actually in very heavy conversations about it. And through that whole process, I just had a moment after one of our conversations where I was like, this would mean we would have to move our family to New York. And I'm totally not a New York person. I'm a Pacific Northwest girl. And live an intense life, work more than I really want to work. I don't want to work 60 hours a week, 80 hours a week. And then it just hit me after that conversation that no, I don't want to be the CEO of somebody else's dreams. Like, it's just, so there was a moment where I was like, okay, this is it. And there was also some other stuff going on as well at that time where we were in the process of buying a company and some other things. So no one thing.
Okay. No, that's helpful to hear all that. Yeah. So I'm just curious, this company you guys bought, what is that?
Yeah.
Does that play in at all to the real estate thing, or is it just a totally separate entity?
Totally separate. It's a high-end specialty fitness equipment retailer. So we sell, if you think of really nice equipment to put into somebody's home gym. We sell that, so strength and cardio and accessories. And then we also do it for commercially, so for hospitality and apartment complexes and corporate gyms and police officer gyms and that sort of stuff. So my cousin had been working at that company for about 13 years. And the founder of it, he had built it almost 40 years prior, and he was in his 70s, and he was like, I'm done. I want to be done with this thing. I'm either closing it down in 3 months or I'll sell it to you, Adam, who's my cousin. So Adam came to us and he's like, you guys are the most business savvy people I know, and I would just love your advice. And it ended up morphing into this conversation of how about we help you out to get this taken care of. So I don't have a lot of day-to-day responsibilities with that company. I work more on the back end with the finances, but my cousin's growing that thing, and we grew at 38% in our first year.
Oh, nice. Good job. That's awesome.
Pretty sweet. So we're having fun with it for sure. And it's been really cool to grow relationship with my cousin as well.
Cool. Yeah. Side note. So you guys sell like treadmills and that kind of thing?
We do. Okay. Yeah.
Yep. My wife and I would have bought it from you if I'd known, but we just bought a new treadmill and it got delivered to our house yesterday. I didn't realize how heavy those things were. Ours was 300 pounds. And
yeah, they're pretty beefy.
We were trying to get it down a flight of stairs, and I'm not even joking. Like, I almost broke both my legs in the process. It was like, sitting in my lap as I was trying to scoot it down. It was a nightmare. But we barely did it. So.
Oh, well done.
Yeah. Anyway. Just warning out there, anybody who buys a commercial grade treadmill, they are incredibly heavy.
Have somebody bring it into the house for you. It's totally worth the white glove delivery service fee.
Yeah. I think it was like $500 or something. We could have had somebody do it. And honestly, it's not like a lot to me. I don't realize it'd be that much money. And that's why we didn't end up doing that. But after that experience, it's like, oh my gosh, I'd rather not die, so maybe it is worth it.
Yeah, dying isn't worth it.
Yeah, not at all.
Or breaking both of your legs, for that matter.
Yeah,
you couldn't use the treadmill that you were going to buy.
Yeah, seriously, I kind of need those things. So going back to this whole thing of leaving your job, and I know when I left my job, something that I just agonized over for the longest time was kind of just a risk assessment. Did I have the income to do this? What if everything just fell apart the day after I quit? Then what? Just really all the sustainability of that. It sounds like for yourself, your husband was working as well, and your income was kind of extra income for fun, there's something to be said for that. But it's not like you would have been homeless on the street.
No, we weren't going to be homeless. Nope.
Yeah. And I think that's really a smart way to do it. There are some people who kind of like just love the thrill of doing their own thing and just like burning bridges as they walk out the door, that kind of thing. And those are kind of like the things that you hear stories about most often, like, because those are the most like riveting stories, like, oh, look what he did. The stakes were so high and he pulled it off. But in real life, like, it's probably smarter to just like make sure you're ready to go and it's going to be okay before you pull the plug on the job. Would you agree?
Yeah. And not only that, if you are doing this for real estate investing, there's this whole thing called financing, right?
Mm-hmm.
And if you are a solo entrepreneur, you don't have a spouse or a business partner, and you're doing this, let's say in single family housing, you cannot get qualified for a loan based off of the merits of the property alone. You can't. You have to have W-2 income or a bunch of passive income that will cover all your living expenses, plus all the extra risk associated with that property on your tax returns from the prior year. Not only that, but they want to have 2 years of tax returns showing all that information. So that's something to be really prepared for. If you are a solo entrepreneur and you are not married and you don't have a business partner, you got to build up your portfolio first.
Mm-hmm.
With commercial investing, it's different, of course, because the lending is based primarily off of the merits of the property, the experience of the investor, and the net worth of the investor, and the liquidity reserves of the investor. So even though, if let's just say my husband quit his job, we could probably still get commercial financing for 5 or more units on apartment buildings because of our liquidity, our net worth, and our experience as investors. That said, it's way easier to get it done when you still have a W-2 income to just kind of back things up and show that you have some extra reserves coming in when you need them. So it's something to think through big time.
No, that's good to hear that perspective.
Yeah.
So I just help us understand, like, when you quit your job and even today, like, how many properties do you own yourself? And I think some of these properties you work on are syndicated deals. So like, you don't necessarily own all of it, but do you own like parts of it, or how does that work?
Yeah. So we had a portfolio of single family houses that we had worked on acquiring from auction, and we are systematically selling those off right now. We're going to sell off the remaining 2 this year. And the reason why we're doing that, just as a side note, is because the market is so hot in the Seattle area, and we like to sell when it's high and buy when it's low. That's not always the sentiment of the market. And we also are using those proceeds to pay off our primary residence mortgage so that we can reduce our living expenses as much as possible, and then be able to have my husband walk away from his job, hopefully sooner rather than later, because of all of our passive income that we have, because then it's less requirements that you have, right? To financial requirements. Okay. And then I just got sidetracked, because what was your first question as related to that?
Basically just trying to understand, like, how many units you own.
Right. Okay.
Yeah.
Yep. So we're selling off our single family and focusing on multifamily. And the multifamily I've purchased, I've had like 5 units or 5 apartment buildings under contract in the last 9 months. We ended up going through with 2 of them. And one of them, when you do syndication, the managing partner, which would be me and my company, the Marota Group, you receive an equity stake in that deal for putting together the deal and all the work up front, and being the sponsor and signing for the loan and all of this, right?
And
so
actually, before you go any further, for those out there who don't know what syndication means, what is syndication?
Okay, great question. So syndication simply means that they're at its very simplest level, it's a group of investors that come together to buy a property. Okay. So in the syndication model that's talked about more frequently, sometimes there's large syndicators and smaller ones, but you have usually one person or a team of a couple of people, business partners, that go out. They find an opportunity for investment, scour the market, usually for something that's, rents are under market, or there's deferred maintenance. It's a value add property. And then those business partners or that individual They go out to their network and they find other like-minded people that would like to invest alongside them in this particular asset. And those other investors, they are limited partners, and they are basically buying shares of the LLC or the company. And then the LLC then purchases the asset. So they are all limited partners in an LLC. And it's strictly passive investing for the individuals that are limited partners. So they have, say, usually, let's say, it depends on the operating agreement that's drawn up, but maybe if there's decisions over $100,000, like if there's going to be a sale or a refinance, then a vote would go to the members of the LLC. But other than that, it's, I'm going to collect my quarterly cash flow distributions or whenever they come along for depending on the operating agreement. And then the managing partner decides on all of the day-to-day operations, works with the property manager, works on the business plan, the strategy, any renovations, works with the lenders to make sure that's all under control, works with the attorneys, any sort of vendors that you need to work with as part of this asset acquisition, the managing partner takes care of.
And that's what you have been with these deals, right?
That's what I have been with these deals.
Okay.
Yeah.
And are you the one, you're the one who's essentially finding the opportunities as well, right? And making the offers and negotiating and all that stuff?
Yeah. And so I use that a variety of sources for that. I try to make great relationships with brokers that are in the markets that I want to invest in. And I haven't done any mailings yet. I'm on the verge of maybe doing some of that stuff. Most of my stuff is just through relationships and visiting the markets that I like investing in and setting up meetings with people that I haven't met before. And I've found stuff on LoopNet before, and then through broker connections.
Okay, cool. And in terms of these other investors, like where are you finding them? Or say if somebody has money and they want to get in on a project like this, whether it be with you or somebody else out there like you, where would somebody go to find these kind of opportunities if they've got the money, but they don't want to have their hands in the mud, so to speak?
Yeah. Okay. So let's say somebody has money and they want to invest. You can do some searches under multifamily investing, and usually the really large players will pop up, and you can even type in the city or the market that you want to be involved in. And then another avenue might be to go to some local real estate meetups, specifically multifamily or commercial. This isn't something that's common in the single family or flipping space. You can use private money to lend money for them on those types of deals, but totally different asset class. And what I would suggest is vet them like crazy. Like, you're going to be hanging out with these people, so to speak, for a number of years. It could be anywhere from 12 months to 10 years that you are alongside them for this ride on an asset. So ask a lot of questions. You got to feel like you can trust them. A lot of times I've done this where I've reached out to multifamily investors who syndicate, because I always am a big fan of learning from people that have been further along than me. So I've invested with other people and I've researched a lot of other people. And there's some people I get on the phone, I'm like, don't want to do business with them. They're just treating me like I'm a dollar sign. And they're just trying to get me off the phone as fast as possible. And then there's other people that are really, really interested in you. What are your investing goals? What are you trying to do this for? Is it for funding the college education for your kids or your grandkids? Is it for your dream retirement home? Is it so you can quit your job and travel the world? Is it so that you can just, I don't know, what are the goals? Like, it's really important for the syndicator to ask those types of questions, because you want to make sure that what the asset is going to perform, how it's going to perform, is going to line up with meeting those goals. In terms of me finding investors, a variety of ways. You usually start out with your personal network, friends and family, coworkers, past coworkers, and then beyond there, investor clubs. I go to a lot of those meetings and connect with as many people as possible. Referrals from other professionals like brokers, insurance agents, lenders, property managers. Those are all great resources for finding investors. And then The key that I've heard, and I'm almost to that point, is that once you have a property that performs really well and your investors are receiving some very decent returns, they'll start telling their friends about it. Because if you invest $100,000 in a property and there's a big rehab and a refinance that's done a year later, and you get back, let's say, even 75% of your money in a year or 2 years. So you have 75,000 back. And I'm not saying this is a real scenario. I'm just saying hypothetically, but, and then you still own the piece of the property. And so you're still getting your cash flow, but you can then turn around and reinvest those dollars in something else. Do you think you're going to tell your friends about it?
Yeah, for sure.
Yeah.
That in terms of like what makes, or what would you consider to be a good return for one of these investors? I know sometimes I'll look around at crowdfunding sites like Realty Shares or Fundrise or something like that. And, usually the returns that people can get on those kinds of deals are anywhere from 8% at the low end, assuming things don't fall apart, to, I don't know, 12%-ish, maybe a little bit higher. And I don't think that's normal, but it could potentially be that high if all the stars align.
That feels really low to me.
Yeah. Well, that's probably because it's so stinking easy. You don't have to do anything other than just inject money and wait for it. But somebody's putting in a lot more money with somebody like you. What kind of return would they be getting?
Yeah. My minimum for me to even consider putting an offer on a deal is an IRR, an internal rate of return of 13 to 15%. And even that feels low to me. And just to explain what IRR is, the internal rate of return calculates a number of different factors into that formula. And I may not say this 100% right, but it's not just your cash on cash return. It's what are your annual cash flow? What if you refi after a couple of years, the appreciation and the sale of the asset? So if you're holding the asset for 10 years and over the life of that asset, all of these things happen, that would be your average IRR. Your average return would be 13 to 15%. So that's what I look at, is a combination of all those factors. And, the deals that I've done have been either upper teens or low 20s. So, and I even have one right now that'll probably be more like 29% IRR because I bought a crazy deal. So, it depends on the riskiness of the project. I've looked at some that have been a little bit more stabilized assets and the returns aren't as good, but they're solid, they're 100% occupied property and they probably are not going to appreciate very much, but they'll be fully occupied because of where they're located and such. And oddly enough, I had a couple of investors who turned down that particular deal because they said it just doesn't feel risky enough for us, maybe in 10 years. And that was probably projecting a solid 13% return.
Okay. Interesting. And you might have already said this, maybe I missed it, but the plan with these properties, is it for you to get in, improve them, and sell them off at a certain point, or is it more to hold them long term?
Yeah, I model my holds out for 10 years, and it's not some magic scenario. Mostly for me, it's because I know that on average, a real estate cycle can last between 8 and 12 years on average. Around 10 years, right? So if I'm going to purchase an asset, I want to make sure that I'm holding on to it long enough in the event that there was a downturn, it would give some time to come back up. So I never want to plan to sell something in 5 years because I don't know what's going to happen in 5 years. Also, I love the idea of passive income, passive cash flow. And so I want to have properties that are providing me that as much as possible. So I don't like selling short term. That said, part of a job of a syndicator is to make sure that you're maximizing opportunities for your investors. So let's say you buy a property that has some massive improvements to be done. You do some renovations, you raise the rents a bunch. It's now at market. It's a stabilized property. You could present it to your investors and say, hey, we can get this much if we sell it right now. What would you guys like to do? Or let's refinance out and get you 100% of your cash back. So those, I think that's the job of a good syndicator, to present opportunities and receive the feedback in order to make the necessary decisions.
So if one of your investors wants to get out for some reason, like, is that even an option, or do they just kind of have to be patient? Like, how does that work?
Everything is always an option. There's always ways, right? That said, it's really, usually when you're getting into these types of opportunities, there's an understanding that it's until the property is sold that you'll be done. If somebody did want to get out, there are clauses usually worked into an operating agreement that say the current members have first right of refusal to purchase your shares. And if none of them want it, you can go out and find an external person to invest, but that person usually needs to be approved by the current members.
Okay. Yep. And in terms of are you essentially doing like conventional bank financing to get these properties?
It depends on the size of the loan. So if it's if it's a small balance loan under $1 million, it's going to be oftentimes with a community bank or such. If it is over $1 million, the loan balance, it'll be a Fannie Mae or Freddie Mac product that you'd be working with. Usually non-recourse debt. Okay.
And so does anybody have to be a guarantor on any of these loans?
Nope.
Okay.
None of the limited partners need to be. That is purely the responsibility of the managing partner. And if the managing partner does not meet the criteria to be the sole guarantor on it, then they would have to bring in a key principal, which would basically be somebody that would they can bring their balance sheet to the table that has additional net worth and liquidity requirements to back up the requirements that the bank has for the loan.
Okay, so you are not currently a guarantor on any of these syndications?
I am, yes.
Okay,
but none of my limited partners are.
Okay, I got you. And those commercial loans, they're typically on a 5-year term, right? And then they renew if the bank wants to continue the relationship, right?
It depends. You can do 3-year, 5-year, 7-year, 10-year fixed. Sometimes there's a balloon payment after the end. Oftentimes it's either a 25-year or a 30-year amortization schedule. So, I listen a lot to the sentiments around the nation of what people are saying we should do. And usually it's around this time, it's get 7 or 10-year fixed money, fixed interest rate money, because the rates are so low right now. And the worst thing that can happen is if I get a 3-year fix and something happens in 3 years, and the rates go up 3 percentage points. And that's when I was planning to refinance. And now I can't refinance because that screws with my financial projections because of the debt service. It's no bueno is what that is. So I'm a proponent for some fixed interest pricing for a longer term.
Yeah. I know I was in commercial banking, back at, from 2007 to 2015, really, it was kind of like the years I was in it. And in those bad real estate recession years, there were a lot of, we didn't do like apartment financing or anything like that. It was mostly small businesses that were going to occupy the real estate, but there were lots of businesses that banks were just kicking out left and right. And like the businesses were doing fine, but the bank was like, well, we decided we don't like this industry anymore. So just because of that, you're gone. Like it was nuts what banks were doing. Luckily, I think a lot of those companies, if they were good companies, like they found somebody else who would take them on. But if they were struggling, like they were done. They were out of business just because banks wouldn't renew their loans with them. So it was a pretty ugly time.
Super ugly. The nice thing about multifamily assets, banks love lending on them. So if you're not in a primary market, if you're in a secondary or tertiary market, you might have to work a little bit harder to find a bank that will lend to a property in a smaller town. But that said, the risk profile for a multifamily property is so much lower as compared to single family housing because you're spreading the risk across, let's say you have a 50-unit building. Well, even if there's a 10% vacancy on it, you still have 45 other tenants paying the rent. And there's no way you're not going to be able to debt service on that. So it's nice right now. Everybody needs a place to live. We are moving more towards a nation of renters than of homeowners. We can't keep up with the housing demand to build enough single family houses. And so it's a solid asset class to invest in.
Yeah, I can totally see why banks would be, more flexible with that type of property than say like a Best Buy or like a Walmart where there's like one tenant and there's not a lot of them that can occupy that specific type of property.
Yes.
I could see how that's substantially more risk for a lender than an apartment building for sure.
Yeah. I've looked at purchasing some properties that are multi-use where you have the commercial space down below and then the multifamily upstairs. And upstairs units. And even that makes me nervous because, those commercial spaces, even if they're 1,000 square foot or 2,000 square feet, they can still be really hard to lease up.
So one question that comes to my mind, I mean, it sounds like part of what makes these deals work is you're somehow finding ways to, bring value to the table with each property, so I guess what I would wonder is, like, are you just buying them really cheap, or is there a specific way that you're improving properties? Or you're like making improvements and then increasing rent? Like, how is it that you're getting this kind of return for you and your investors?
I think the perfect storm for me is to find a property that's a solid C-class property, and the rents are a couple $100s a door under market that has been owned by kind of a mom and pop shop, maybe a family, maybe a retired couple has owned it, who knows, but usually not institutional investors, right? Like somebody that's just held on to it for a long time and maybe hasn't done the best job managing it in terms of like keeping up with market rents. Or maybe they got really sick of making renovations and they didn't have a property manager. So there's some deferred maintenance. So that combination of mismanagement, rents under market, and those interiors could really use some facelifts, right? And if you do the facelifts, you bring in a new tenant profile. The beautiful thing is when you do that with multifamily, the price of that property is based off of your net operating income. So just to give you an example, I'm just about ready to come full circle on a property that I purchased last July, the end of July 2017. It's a 15-unit property. Rents were about $300 a door under market. So market was about $750, $775. The average was $450 a door.
Wow, man, that sounds way under.
I know. And the same family had owned it for about a decade, right? They didn't have a property manager. They were just kind of ready to liquidate and sell it off. And the insides, they weren't horrible. It's not like it was slumlord situation, but they definitely needed some TLC. So we went in that one. We decided to raise rents, not to full market, but to, I think it was about $200 we raised rents. And we decided, okay, whoever stays, cool. Whoever doesn't stay will renovate those units at that time. So we had 5 tenants the first month that left, 2 the following month, and 3 the next month. So 10 out of 15. So we just got done renovating those. And because of the increased value, we've put in about $3,500 a door, approximately, with, let's just say, paint, new vinyl plank flooring, some new fixtures, fixed up the countertops and cabinets just with, like a light paint, and maybe some new appliances, really simple stuff. Well, I bought that for $825,000. Okay. And because I've increased the net operating income by, well, let's see, I think I increased rents $45,000 annually by all of that. Our property is now worth almost $1.3 million. And that's just from July of 2017 to now we're talking, it's basically March 1st right now. Wow. So it's really powerful.
That is amazing. I remember one of the first stories I ever heard about Donald Trump, like the first deal he ever did, he made $1 million just by, I think he like bought a property and raised everybody's rent $20 a month and then sold it without doing anything to it or something like that.
Yeah.
But yeah. I mean, just raising rents like that, especially if you have an easily justifiable way to do it that the market will support. Like, man, that's That is serious power. It's really cool.
It's super cool.
Yeah.
I love it. I'm addicted.
Yeah. Yeah. So I know somebody like me, I don't like debt. Like it just bothers me. I just don't want it in my life.
Yeah.
But at the same time, like I'd love to get to the point where I'm doing what you're doing on this scale. It's one of those things like I'm sure I probably could, but like this disdain for debt has always held me back from doing that. I'm wondering like, how do you get comfortable with debt like that? Is it just like a mind game? You just need to get over it? I don't know, like what's your secret? Have you ever been uncomfortable with the amount of debt on each property, or does it just not really bother you?
So I do not love personal debt at all. And we have none of it. My husband and I, we don't have credit card debt. All we have is our primary residence. We never have loans on cars. We pay cash for everything, right? So when it comes to personal finances and debt, no, thank you. Right. And we're also working to pay down our mortgage as well, which we'll hopefully have taken care of this year. And I think about 4 or 5 years ago, I went through this phase of being like you for a long time where I was super hyper conservative when it comes to finances. And I would still consider myself pretty conservative with finances. That said, I started realizing the power of leverage and the power of leverage specifically as it pertains to acquiring assets and producing wealth. And the way that I got hooked on it was that we had been using our HELOC. We have a home equity line of credit on our primary residence and on one of our other properties as well. And we would use that to pay cash for single family houses so that our offers would be solid. We'd renovate them. We'd put renters in there. After 6 months, we'd refinance, put the conventional debt on the rental property, and then pay ourselves back and pay off the HELOC. So if it weren't for that HELOC and using debt for that short term, we wouldn't be where we are today because of that risk that we could take. But it was calculated risk. We would only pay 70 to 75% of after repair market value for those properties. So we were smart. It's not like we would be clicking up and paying market value or even 90% value. No, we wanted to make sure that when we refinanced it, we would have enough equity in there to pay ourselves back. So that really changed my perception because I saw how it directly impacted our net worth, our portfolio, and it's enabled us to do a lot that we couldn't have done before. So with the multifamily stuff, I see that as not personal debt. That is debt that's on an asset. It's held by the LLC that we guarantee. And especially as I'm working towards getting larger balance loans that are non-recourse debt, they cannot come after, once it's non-recourse debt, they can only go after the asset. They can't go after me and all of my personal finances. So I'm aiming towards only working on balances that are that large for the assets that I'm purchasing in the future. And that makes, to be honest, it does feel kind of, I don't love the fact that we have a couple of $600,000 loans with our names on it because those ones are full recourse. However, I'm also the person that manages it. So I know that if I'm managing it, there's no way that I'm going to let that thing go to hell in a handbasket, right?
You have some control. You're not just like powerless to the situation.
Yes. Yeah. And I usually make pretty good decisions. So you definitely have to feel comfortable with it.
And I know part of your ability to identify opportunities and places where you can add value to a property and increase cash flow, I imagine a lot of that has to do with being intimately familiar with whatever market you're working in, like what comparable units would rent for. So like are all of your properties in the Seattle area where you're at, or like if they're in other markets, like how did you get familiar with those markets? How much time did you spend there learning those areas?
Yeah, I do not invest in Seattle. Number one, because the landlord tenant laws here are horrific and it's just crazy being a landlord, but also because it's hyper competitive and the cap rates are so condensed here that it's highly prohibitive to make any decent returns. It's all speculative based off of property appreciation, and that's not what I do. So I look at least 2 counties away from the Seattle King County metro area. You have the prices will go down. You have a tiny bit less competition. The tenant profile's a little bit different, but again, everybody needs a place to live. So the areas that are within an hour of where I live, I know all of them well because I've lived in the Pacific Northwest more or less my whole life, with the exception of like 5 years.
Mm-hmm.
But the place that I'm really interested in is about 4 to 5 hours away, actually east of the mountains, basically.
Mm-hmm.
And some of those cities I have not been to before, some areas that I would like to invest in. So I will go over and spend time there. But the areas that I have invested in, I've just taken a couple of day trips and drove the neighborhoods, try to figure out, okay, which part of town is ick, steer clear,
Mm-hmm.
which part of town is the nicer areas, where are the multifamily units concentrated? Are they downtown? Where are they? And so I got good feel for that just by driving neighborhoods. And even one day doing that was so enlightening, because then at least if you're pulling it up on Google Earth or something, you're like, yep, I've driven that neighborhood. I at least, maybe not down that street, but I've been within 10 blocks of this area, so I can have a general feel for it. And then leveraging relationships in those towns as well. So either through property managers or lenders or brokers, and asking them, can you be boots on the ground for me? Go check this out before I fly out or drive out 5 hours to go see a property. I think that's really valuable. And sometimes even I know people who live in those communities, and I can just ask them to go drive by and take pictures or something.
Mm-hmm. Wow. Yeah, it sounds like those relationships are pretty darn important in that kind of business.
I agree.
Just out of curiosity, being a woman in the real estate investing business, do you ever feel like you're, up against any particular challenges that a man would not have to deal with? Like, do people treat you differently or anything like that? Have you noticed that kind of thing?
I feel like I'm the wrong person to ask that question, only because I've always hung out with dudes, right?
Mm-hmm.
Like my whole life, I just have a lot of guy friends, and I was a total tomboy growing up. And I don't really picture myself as like, a woman working in a man's space, although I recognize it all the time, because who am I going out to coffee with all the time? Dudes.
Yeah. Mm-hmm.
Who do I hear on podcasts, and who do I see writing blogs, and who's writing all the books? Dudes, and that's why I'm trying to get my voice into this space to empower other women that they can do this. I don't think it's impacted me one bit, because as you can probably tell, I'm not super shy. Mm-hmm. And I'm very driven. And so I think if you have that going for you and you're confident in your abilities, that I'll go into whatever market, not even, not just real estate, but I'll go into any industry and crush it, because I know I'm capable of finding the resources that I need to find. Yeah. And it's also just not being intimidated that you're the only female that's showing up for meetings that are doing this or whatever it is. But it's definitely noticeable, but I don't let it affect me, because it doesn't bother me.
Yeah, interesting.
That said, I will say that I just got a quote back from a contractor, and it was probably about 4 times higher than it needed to be.
Oh, wow.
And I only know that because I've been doing this stuff for a long time, and I've renovated our own houses. I've quite a few, and we've done tons of flipping stuff. Like, I know how much stuff costs, and I swing hammers, and I get dirty, and I paint and all this stuff. And so I don't know if that was one of those things where he's like, oh, it's east of the mountains and I have to bring everybody out there, or if it's like, oh, well, she's a woman. I don't know. But I don't just choose not to think of it that way.
Yeah.
If that makes sense.
I think that's great advice. I know, like, coming from the banking world, like, I know that kind of chauvinism, that kind of thing, like, that was there. Like, I saw it pretty regularly too. But at the same time, like, there were times I feel like people treated me differently simply because I was not speaking with confidence with what I was saying. Like, people just kind of assumed I was clueless about certain things. Not because I was, but because like I wasn't in your face about what I thought the answer was. And I think a lot of times it may not necessarily be a gender thing. Maybe it's just like a human thing. Like, people are either respectful or disrespectful to each other based on like little subtleties and like body language and just tone of voice and things like that. So I guess however you're treated, like, the reaction is not like, oh, I'm a victim, or it's because I'm a woman, or because I'm this race or whatever that they're treating me this way. It's like,
move on,
respond with confidence and just keep pushing the ball forward, and don't let people get in your way.
And some people are just jerks. Okay. Like,
Yeah, exactly. It might be nothing personal.
Maybe they're just maybe they're like that to whoever they talk to, and I just choose not to do business with those people. Yeah. And so one other point I will say is I have 3 kids. Mm-hmm. I homeschool one of my 3 kids, and he comes with me on business trips and business meetings all the time. And you know that in any industry that would probably be frowned upon. But here's the thing. If somebody wants to do business with me, my kid comes along, and I'm sure some people frown upon that, but he is respectful. He's coming along. He's learning alongside his mom. He's learning crazy lessons that he would never be learning if he was sitting in the classroom at school. And we have conversations to back it up afterwards. And I don't apologize for it. I just say, hey, my apprentice is alongside me today. He's just going to be learning with us in our meeting. Mm-hmm. And I don't let it bother me. I mean, most of the time people are like, super cool, right on. Let's let him listen in or whatever. So I just like to do things a little bit differently.
Sounds like it's working for you. I don't think it's getting in the way.
No.
Very cool. Well, with everything that you've done and all of your experience, just the different quirks of doing syndication deals and that kind of thing, what would you say is the hardest part about making all of this work? Like, what's the biggest pain for you or the biggest difficulty in making this all happen?
Well, I think it's different at different times. Right now, I really want another deal because I have a bunch of investors lined up, and I want a deal, and I keep finding deals that just are not solid deals. So I'm not going to take them just because they're coming across my desk. Mm-hmm. So sometimes that can be the pain where it's like, oh, either you have a bunch of investors and no deal, or you have this deal that come across your desk and you're like, oh, junk, I got to find some more investors. Yeah. So I think it's that combination of connecting those two pieces together that can be somewhat challenging. Otherwise, I don't know. It's not even a huge angsty thing. And there's nothing else that really bothers me. I love what I'm doing. It's a relationship business, and I love seeing how I can transform communities by the work that we're doing, by providing better quality of housing, cleaning up neighborhoods and impacting the lives of the investors that I work with in a big way.
Yeah. Yeah, the cool thing about your response to that question is that it's almost like you had to search hard or think hard to think of what was so hard about it. Sort of tells me you're not the kind of person that sits around and just agonizes about what's hard. Like, you're just focused on finding solutions and moving forward. And there's something to be said for that. I can't say I'm always that way. Sometimes I just get hung up on things and I'm just like, oh, I hate this, But, if I thought more like you and just focused on solving the problem, it would probably not be a problem anymore. So that's pretty cool. I like that.
Thanks for saying that. I think the more we can focus on finding solutions for anything, the better, the more successful we're going to be in life. And the more that we can find solutions for other people's problems, the more successful we're going to be in life.
Yeah, for sure. Makes sense to me.
Yeah.
Well, Tamar, if people want to find out more about you, get a hold of you for anything like that, where should they go?
Yeah. Well, you can certainly pop on over to my podcast, which is the Investing for Life podcast. It's on iTunes and Stitcher, or you can go to investingforlifepodcast.com, or my company webpage, which is the marotagroup.com, MAROTA group.com.
Yeah, I'll go ahead and link to both of those things in the show notes for this episode. So if you want to just get there, you'll have a link there as well too. So
cool.
Well, Tamar, anything else you want to add before we wrap this up?
Hey, just go out there and crush it, friends. That's about it.
Well, I totally appreciate your time and appreciate all the listeners out there for tuning in and checking out this conversation. Hope you guys got something out of it. And we will talk to you in the next episode.
Sounds great. Thanks, Seth.
You bet. Thanks.